So, bank stocks rallied big after global bank regulators issued some milder than expected new rules for capital. CNBC's Mary Thompson has the whole story. Hello, Mary.
Well, Larry, clarity on Basel III capital levels spurring a rally in bank stocks today. The Basel Committee raising capital requirements to expected levels, requiring banks by 2019 to hold common equity equal to 7% of their risk-weighted assets, with Tier 1 assets at 8.5%. The news well received by bank CEOs. Here's Morgan Stanley's James Gorman.
The Basel rules, I mean, what we needed was certainty, and we're finally getting some certainty. The new capital requirements, liquidity requirements are not unanticipated, and we're comfortable with that. I mean, what we and the markets, shareholders are looking for is certainty, and will make for stronger banks as we move forward.
The news sending banks to their best levels in a month, as many U.S. banks, especially the big ones, meet or can meet these requirements by the deadline. In fact, some banks are overcapitalized, raising hopes that capital will be returned to shareholders via dividends or buybacks after regulators give the okay. Bank of America CEO Brian Moynihan calling the rules reasonable. Wells Fargo CFO Howard Atkins saying Basel III means his bank has to make up a manageable $3 billion gap. And Alabama-based Regions Financials calling the rules moderately impactful. As for Capital One, it says it's more of an issue for Wall Street rather than Main Street banks like Capital One. These firms also commenting about the state of their business and the economy, and their outlooks remain cautious. Capital One and Regions seeing weak overall loan demand as consumers continue to deleverage, and commercial clients seeing no need for new loans because of tepid end-user demand. Bank of America saying high unemployment remains one of the biggest challenges, while all say the economic recovery remains fragile and uneven. That being said, none of the banks say they expect a double-dip recession. On the plus side, they also believe the banking industry is in much stronger shape than it was a year ago. The better balance sheets making it easier for the banks to take advantage of a growing economy. Growth, of course, dependent on a turn in employment and an improvement in that still weak housing market. Larry, back to you.
All right, Mary, thanks very much for the update. Now, the September rally rolled on Wall Street today. The Dow up 81 points. The Nasdaq gained 43. The S&P rising 12. So, is a big rally brewing as I think possible. Let's look at today's optimism checklist. China growth, the numbers out of China good. The Basel capital phase-in over a long period of time that Mary Thompson discussed. Here's some new information. Microsoft is going to issue debt for stock buybacks and dividends. That's very good. Oh, by the way, Warren Buffett and Hank Paulson both said today they see no double dip. I interviewed Hank Paulson before a Midtown conference in New York City. No double dip. Now, we still have a little bit of pessimism in today's. I'm being very realistic and honest. We have a lot of tax uncertainty from Congress. We may not have tax rate increases now, but we don't know a year from now. We don't even know 3 months from now. So, are we in for a big stock market rally, as Kudlow continues to argue in the last few weeks? Well, let's talk to Lee Munson. He's Chief Investment Officer, Portfolio Asset Management, and Joe Battipaglia, Market Strategist at Stifel Nicholas. All right, before Lee jumps out of his socks with optimism, which is cool, because I'm basically in his camp now. But, Joe B., it is interesting. It's hard to celebrate the lack of a tax hike on upper-end earners and investors because we really don't know, Joe, how this Washington tax story is going to play out. We hardly know 20 minutes from now, much less 20 years from now.
Yeah, I'm afraid that fiscal policy now is not broad-based, propelling all of us and the economy higher, but rather it's targeted to here, targeted to there. And I think President Obama has a dilemma. He remembers George Bush the first, who made a promise about not raising taxes, capitulated, and was buried in the election. He made a promise to raise taxes, to level the playing field. It wouldn't hurt the economy. So for him to back down from that here is politically exceedingly difficult. In addition, these targeted tax cuts and reliefs for R&D, etc., do not have the same firepower as a broadly based stimulative program for all Americans. So that's why at this point in time, the stimulus, the quantitative easing steps are all late-game programs because the economy itself is slowing down and there's no catalyst for real growth in the private sector with credit demand still shrinking.
Yeah, neither side wants to back down on this debate. Okay, so the Bush tax extenders into a hole till the end of the year. Lee Munson, there's a great story running on one of the news services. The VIX Volatility Index, okay? You're trading in and out. That thing's gotten so low that some people are saying the VIX futures is predicting a better than 30% stock market rally. Now, Lee Munson, you need to explain this to us. A 30% rally predicted by a low volatility index called the VIX.
Right. Well, basically, the viewers at home just need to know what the VIX is. It's a way of pricing the options that people use to trade the S&P 500, the most widely watched indice in the world. So basically all the VIX really says is if it says 20 or 30%, that's just how much a market can go up or down over, say, a one-year period of time. Now, the math is pretty complicated, but here's how I take it. When the VIX goes down, everybody's suggesting that it's fine. Everything's wonderful. But, Larry, you got to admit, you're a little bit of a Larry come lately when it comes to the rally here. Because 2 weeks ago, you're arguing with me, calling me Pollyanna-ish, that I thought that we were going to get a rally.
3 weeks ago.
Oh, okay,
no,
okay.
It was
3 weeks ago.
No, I've been good in September. I looked at those earnings numbers, man. I'm excited about earnings. I want to get to earnings in a minute. But just tell me about this. Does the VIX, is there too much pessimism? Is there too much pessimism, Lee? And is the VIX signal something that investors should pay attention to? Or is it all hogwash?
So.
Is it all hogwash?
I talked to my head trader for my hedge fund. His name's Chris Bondi. We work on models all day long. And Chris and I were talking that the S&P is getting to the level where we might take profits off the table and sell short. But here's what you have to remember. If we surprise on the upside any economic number that comes out, the shorts are going to get killed. Every technician out there is talking about 1150 in this range-bound market. But with the VIX low right here, personally, I want to see the VIX go lower, the market go 3 to 4% higher. I think the market can go higher, and it's going to be a big surprise to a lot of traders out there because they're so convinced that we're in this tight range-bound market. They talk about the fundamentals of there's the tax uncertainty, this or that, the other. Bottom line, you're right. Profits are up.
Yeah.
Companies are making more money.
That's the
and
key.
if there's anything that's going to be up, it's going to be the banks, and they're going to lead the rally. So what I would say is...
All right, hang on. I got to get back to Joe. I got to get back to Joe. We got a lot of work to cover. Because, Joe, look, ever since I came back from vacation, September, basically, record high profits, record low interest rates, Joe. I don't want to make it any more complicated than that. Tax policy is not going to get resolved in the near term. But, Joe, what is your take on that? Lee's very optimistic, and I confess I am too. Where are you coming out on this?
The VIX index was at a low right before the banking crisis in Europe broke, and then it went to an immediate new high. And we're at essentially the same level on the S&P where we were in November of last year. What that tells me is that basically the economy peaked in the fourth quarter of last year. It's been on a slow, steady decline. And while we can celebrate the fact that we won't have a double dip and that the government will once again come in to intervene, there are no natural stimulants to make the private sector in the United States, Europe, or Japan, for that matter, be strong economic contributors anytime
Besides
soon.
Profits,
we still
Joe.
have continued credit deleveraging.
Besides profits, Joe.
Well, to
Besides
the profits.
Profits
the
are more
profit
important
expectations,
than the
Larry,
economy.
the profit expectations were higher earlier in the year when we were celebrating 3% plus V-shaped recovery, which has not appeared. It's declining now, and the analysts have cut their estimates. And with that, the market stopped rising. So there is a correlation there, and we should recognize the fact that it is an uncertain outlook. The bankers themselves, in their own statement, are talking about the unevenness of this fragile recovery and the fact that the outlook is kind of tight here. With
they're sandbagging everybody so they can get more money from the Fed. Please, what are they supposed to say? Everything's great. Why don't we sell our treasuries back to the Fed and not get this free money? Larry, you're talking about 40, 50% spreads.
But the reality is that unemployment is still trending higher, not lower. Housing is still in a depression despite record low mortgage rates, despite a Fed that is basically all in on every characteristic one can measure, and you're still getting 1 to 2% growth in GDP in the world's most important economy. That's not a recipe for good outcomes in 2011, and it's certainly not one that the banks are just talking up because they want more help from the Fed. This is the real situation that exists today.
Lee Munson, can we get back to the April? Can we get back to the April highs? In other words, I believe in first things first, one step at a time. We need to get back to the April highs. We are, let's see, as of today's trading, the S&P is 8 percentage points below the April 23rd high. Can we get back there, Lee?
I think we can, but I think that there's a couple things that are going to have to happen. First of all of the traders that are out there that are looking for this range-bound market, they're going to have to get surprised. In order for that to happen, we're going to have a few economic indicators, just like we had with unemployment a few weeks ago, surprise on the upside. Okay, when you look at something like September 3rd, when the unemployment numbers were 10,000, people, less than what Wall Street expected, the trading floors were on fire. But right now, on Friday, a lot of people I was talking to who are trading Treasuries said there was nothing but bids on Treasury, meaning people were still looking for the risk-adverse trade. I think those people, I love Treasuries, I like it, but in order for us to get more than maybe 3 or 4% higher, we're going to need a surprise. I think it could happen. I don't want to short the stock market right now because I'm convinced any little thing that jars that range-bound market, we go up. And it has nothing to do with what's going to happen with the elections or the tax uncertainty. Like, anybody thinks that we're going to fix this tax problem anytime in the next year?
It's funny. As a guy who loves to talk money politics, I actually agree with you that we have exhausted the talk about tax cuts and whatever. Republicans are going to sweep the House. We already know that. Republicans may take the Senate. We'll know that the night of November 2nd or the morning of November 3rd. That would be interesting. It would be new information. But until that time, I think the politics is on hold. Joe, last word. Do you have any sense, I don't mean to put you on the spot, but I think Lee has a point about the economic numbers. We get retail sales tomorrow, Joe. It's potentially an important figure. Any sense of what it might look like?
I think they'll be decent and may even surprise by 1/10 of a point. But that's insufficient in the trend of things to tell us that we have a new upturn in the economy here. And in fact, because of where the level the S&P is, it seems to me that no one ever moved away from their expectations of a V-shaped recovery 8, 9 months ago. And now they've accepted the fact that we've just got a weak economy. And the only thing holding you up here is the Federal Reserve and the federal government, who's all in here. But I tell you, if the Republicans don't have a majority after this election, then you have a stalemate of the worst kind, where bad policies get implemented, nothing new can get done, and the economy's on its own.
Pessimism's going to make the market go up, guys. Pessimism's going to make this thing shoot higher.
Joe B., in 5 words, what's your single favorite investment? I'm out of time.
Well, we have 3. Laddered corporate bonds, gold as a hedge on currency, and then we have large cap growth stocks to get whatever global growth it is.
All right, that's great stuff. Lee Munson, what's your favorite investment? Real quick, 5 words.
Bank of America, Goldman Sachs, Treasuries.
You're both terrific. Really, that is impressive, both of you guys. Lee Munson, thank you ever so much. Joe Battipaglia, it couldn't be better.